Smart money is doing one thing with gold right now and retail investors are doing the exact opposite. Let me show you exactly what the data says, because the positioning divergence we are seeing today is as wide as it has been in over a decade, and history is very clear about what happens next. Gold is sitting at $4,113.70 an ounce right now. That is not a typo. That is not a bubble headline from a fringe newsletter. That is the spot price, today. And yet the most searched question on Yahoo Finance this week is what is a good savings account interest rate in 2026? People are genuinely asking whether a 4% savings account is a good deal while gold has returned over 35% in the last 12 months. That gap between where the smart money is sitting and where retail attention is pointed is the entire story today. Let us start with the Commitment of Traders report, the COT report, which is the weekly data the CFTC publishes showing exactly what large institutional traders, hedge funds, and commercial players are positioned in on the futures market. As of the most recent release, managed money net long positions in gold futures are near their highest level since 2020. That means big funds are betting heavily that gold goes higher, not trimming, not rotating out, adding. Meanwhile, retail sentiment surveys, including the AAII survey and Google Trends data, show gold is not even in the top 10 most searched investment topics right now. People are searching for savings accounts. Here is a number that will stop you cold. Central banks globally bought 1,045 tons of gold in 2023 and followed that with over 1,000 tons again in 2024. That is 2 consecutive years above 1,000 tons, something that had never happened in recorded history before. These are not retail investors panic buying on a Reddit thread. These are sovereign wealth managers, national reserve banks, institutions that manage the savings of entire nations, and they are buying gold at a pace that has no historical precedent. China's central bank alone added gold to its reserves for 18 consecutive months before briefly pausing in mid-2024. Poland, India, Turkey, Singapore, all adding at the same time. That is not a coincidence. That is a coordinated institutional signal. Now contrast that with what mainstream financial advice is saying. The consensus recommendation from most financial advisors right now is to lock in a high-yield savings account while the federal funds rate sits at 3.63%. And on the surface that sounds reasonable. 3.63% is not nothing, but here is where the math gets brutal. The US CPI index is currently at 333.979. Real purchasing power, the actual amount of stuff your money buys, is being eroded even at current inflation readings. A savings account paying 4% to 4.5% sounds like a win until you realize gold has compounded at roughly 9% annually over the last 20 years. The savings account is not keeping you ahead, it is helping you lose more slowly. Let us talk about ETF flows, because this is where the retail versus institutional gap becomes almost absurd. In 2022 and 2023, when gold was trading between $1,800 and $2,100 an ounce, retail investors were net sellers of gold ETFs. The SPDR Gold Trust, ticker GLD, saw significant outflows during that period even as institutional buyers were accumulating in the futures market. Fast forward to today, gold is at $4,113.70 and ETF inflows are finally starting to tick back up, which tells you retail is beginning to chase the move after the bulk of it has already happened. This is the pattern. Institutions accumulate during the quiet period. Retail arrives at the party after the best seats are taken. Here is a data point most people have never heard. In the 12 months before gold broke $1,000 an ounce in 2008, hedge fund net longs in gold futures rose by over 200%. Retail ETF inflows did not meaningfully accelerate until gold was already above $1,100. The same pattern played out before the 2020 breakout above $2,000. Managed money was aggressively long from $1,500. Retail sentiment did not turn bullish until gold was already trading above $1,900. We are watching the same movie again. The smart money loaded up below $3,000. Retail is just now paying attention at $4,113. Let us add more data points to this picture. The gold to S&P 500 ratio, which measures how many ounces of gold it takes to buy the S&P index, has been falling steadily since late 2024. That means gold is outperforming equities on a relative basis. When this ratio has historically fallen sharply, portfolio managers who were underweight gold have been forced to rebalance, which creates sustained buying pressure, not a one-day spike. We are in the early stages of that rebalancing cycle right now. Additionally, the Bank of America Global Fund Manager survey from early 2025 showed that the single most crowded trade among fund managers was long gold. Not long Nvidia. Not long crypto, long gold. That is your institutional signal in plain English. Now let us address the counterargument honestly, because you deserve a complete picture. When a trade becomes crowded, meaning everyone on one side, it can become vulnerable to a sharp reversal. If hedge funds are all long gold and something triggers a rush to exit, the price can drop fast. We saw this in August 2024 when gold briefly pulled back 3% in a single session as funds liquidated positions to cover losses elsewhere. So the smart money positioning is a signal, not a guarantee. The difference between 2024 and today is that the macro backdrop, de-dollarization, central bank reserve diversification, and US debt now exceeding $36 trillion, has not changed. Those structural forces do not reverse in a week. They play out over years, and here is why that matters to you. Most people think the gold trade is about fear. It is not. It is about math. And the final number in this breakdown is the one that changes how you see everything else. When a government borrows faster than it grows, the long-term purchasing power of its currency declines. Gold is the 5,000-year-old hedge against exactly that outcome. Every institution that manages serious money knows this. Every central bank buying 1,000 tons a year knows this. The question is whether individual investors will figure it out before or after the next leg higher. So which side does history say wins when this divergence between smart money and retail closes? It is not even close. In every major gold bull market of the last 50 years, the institutions that were positioned early captured the majority of the gains. Retail investors who chased the move captured some gains but also absorbed the volatility because they bought in with emotion, not analysis. The divergence closing is not a maybe. It always closes. The only question is whether you close it on your terms or on the market's terms. If this kind of data-driven breakdown is useful to you, subscribe to this channel right now. Every week we track exactly what central banks, hedge funds, and institutional players are doing with gold and precious metals, and we translate the COT reports, ETF flows, and macro data into plain English so you can make informed decisions instead of reacting to headlines. Hit subscribe, turn on notifications, and you will never miss a smart money signal again.